I want to ask you a question. You and I are business guys, right? We're in business.
Yes.
If there was a business that the only way it could grow was from leveraging debt against previous assets, would you invest in that business?
No, I definitely would not. It sounds risky.
Have you heard of Enron?
Yes. Great movie, by the way. But yes.
All right, so I'm going to tell the story of Enron to really frame this one up in an even more deliberate way.
Such a good setup. Oh my God.
We're getting dirty here now, are we? Straight out of the gate.
Oh my God.
You didn't think I was going to go for it, did you?
I thought you were going to dance around it a little bit, but no, straight to the guts.
Okay, so Enron was I'm going to say probably started out on good intentions, probably.
Like most things.
And then got way out of hand.
Yep.
I mean, I can't speak for it, but in summary, Enron was actually a medical company who had worked out that the most expensive part of being a pharmaceutical company or medical company is the research and development. So they had come up with this idea with what they would do is just acquire other companies and then strip out all the research and development to make the share price go up. But what they ended up with is a massive conglomerate of company with no new drugs coming onto the market. And then some questionable accounting tactics came into the back end of it. Fraud and scam. Allegedly. I'm not going to go into that from there, but it can be quite dangerous. So the ramifications of investing in a business when they do those types of things can be dangerous. And I actually think there's a lot in common with property investors who just use equity to kind of grow. I think it's missing this whole business lens. And I think for a lot of people, if they were to think about how would you feel if your superannuation was only going into companies that were growing in this way? They're just utilizing debt leveraged off previous assets. They're not producing profits and reinvesting profits. They're just leveraging assets. It's quite risky and quite dangerous. And because I think you and I are uniquely positioned where we come from this business world, we see equity very differently and the use of leverage in this way, opposed to people that maybe don't come from that world. How do you feel about How do you feel about that statement, Grant?
Yeah, it's the concept of understanding the second order consequences of the decisions you make, right? Like to use that business concept, if you were talking to me about the scenario of getting a brand new credit card that might have a couple of $1,000s on it and utilizing that debt to see if a business was feasible, sure, the risk is quite low because it's like, well, if it doesn't work, a couple of $1,000s, I can pay that off, right? So it's quite minimal. But when we start talking about size, so if we're talking about like $1 million and trying to utilize $1 million to try to see if that business is going to be viable, then we're not talking about a debt amount that I can go and just work off after a year or two. We're talking about a sizable amount that actually has catastrophic impacts to me where I do not have the ability to control it if it doesn't work out. And it's those second order consequences that are really important to me.
Do you think the banks have made this too easy and a little bit misunderstood to encourage people to pursue such paths? And it might not even be the banks, but someone out there is doing it, although it's probably the banks. They make the money off lending money, so it would make sense.
Yeah, there are a couple of people who do it. And I think Banks is obviously one of them, but I think that there are some other people that have provided the insight of going, well, you might not be able to accumulate cash quick enough, so the best and easiest way for you to get cash tax-free is refinancing and extracting money elsewhere. And that is the easiest way and the fastest way for you to accumulate more, when in actual fact, they don't talk about the second order consequences of, well, what happens if scenario 1, 2, 3, 4, 5, which is more probable than the benefits of other scenarios of 1 and 2 and 3.
Let's frame up what equity is first to make sure we get everyone onto the same page. Okay, so I'm going to use the example here. Let's say you buy a house for $500,000, 500,000, and that property was to go up in value over time to $1 million. There is $500,000 of equity, which is the gain on that property that has not been turned into cash or would only be turned into cash if sold, that's sitting there.
Yep.
Now, what the banks will allow you to do is actually borrow money against that equity. So let's just dispel myth number one. Equity is not free money you can just access. It's a loan against the equity in a property.
Completely.
Right. So very, very key framing there. I still can't believe how many people have been confused by that concept that, well, it's this money there you can just get and it's like free.
It's yours.
Grant.
It's like a bank account. It's yours. Just take it.
It's a loan that you will be charged interest on
But it's also a loan that you have to go through some kind of application process to access.
Oh, yeah. Again, you have to look to the actors that play in this space and go, the banks want to lend money. That's what they do. Of course, they're going to be encouraging of that. That's their business. What's funny is we have a whole organization called APRA that their role is to keep the banks in check, because if left unchecked, will just allow you to OD on loans.
Do you reckon
just
that's
take as much as you want.
If it's like, if they don't become checked, they're just just a bunch of people are just sitting there ODing on loans.
Well, isn't that what happened in like 2018 and stuff? That's why they were brought in.
Yeah, people need the bumpers. I get you.
Completely. So I think that is really key framing on what equity is there. Okay, it's a loan secured against another asset. I quickly want to touch on why people use equity rather than not. So here's the kicker that makes equity so attractive, is that if you were to get a loan via equity, is that because you haven't sold the asset to extract the gain, it's not a taxable event.
Yeah.
So this is the big perk. This is why people love it, is if you, in this scenario I've described here, if you didn't have to sell, so let's say you bought that property for $500,000, it went up to $1 million and you sold it, well, you would have to pay capital gains tax on that $500,000 that's gone up to $1 million, which could potentially be $250,000.
Completely.
Right? It's a lot of tax to pay, where if you did not and only took a loan against it, it's not a taxable event.
And that's where the win is, Charlie. Surely there's no downsides to this at all.
It's very attractive.
Until,
well, let's just use recent times as the example here. Let's pretend this legitimately was someone's situation and they did this 3 years ago. And they're like, cool, rates are low, the interest is low, I've taken this loan out. And then you've got this equity, and then you've bought another property with the equity out. So technically, you might be able to buy a property with like no deposit or no money down in this scenario.
Yep.
Through the use of equity, you've taken out some money from another property, used that as a deposit into another one, and bang, you're off to the races. Maybe you bought another property, except the reality of that situation is you've bought it on 100% finance.
Yep.
Or more. I know of people that would get 105% because they would do their stamp duty and purchasing costs within it as well. Again, to sort of do a pause here, if you're buying property at 100% debt or 105, company you'd invest in, Grant?
Definitely not. If a company needs 105% debt in order for them to run, yeah, it's concerning, because just everything that we're about to run through.
Well, this is the other part of it, is that in the scenario, and I'll just use this as a thing, if you leave a 20% deposit when you buy a property and you get an 80% loan, right, you're actually massively improving the cash flow on a property, because you're only having to support 80% of the property value, not 100%.
Yep.
In the scenario where you're using equity and not contributing any deposits, the amount of cash that is just not being used turns into a much more negative cash flow cycle.
All right, fellow property investor, if you loved the value from this short video and wanted to know more about how you can win at property investing, check out the full episode by clicking the link on your screen or in the description right now. Alternatively, click subscribe and you'll never miss another one of these videos.